All right, well, welcome to part 2 of our Understanding Credit unit. Today we are going to talk about credit worthiness. So credit worthiness is when credit approval depends upon a borrower's perceived credit worthiness. This is how a person uses credit affects their credit worthiness. Credit worthiness is determined by a credit report and or a credit score. So the 5 C's or the 5 characters of credit determine your credit worthiness to a lender. What they're going to be looking at is first your character, and this is responsible behavior toward repayment of your debt. Are you making your debt loan payments on time? Are you making them ahead of schedule? Have you paid them off? Are you paying more than the minimum payment? Capacity is your ability to pay based on income. So does your weekly, biweekly, or monthly paycheck meet the needs of making the loan debt payment? Capital is the property you possess that is worth more than your debt. So what assets do you own minus your liabilities that would be able to cover that debt in case of inability to pay? Conditions would be economic conditions that may affect your ability to repay. Does your job have any effect, or does it have any repercussions based on the economic conditions? Are we in a recession, and how is your job outlook? And then collateral is the property pledged to assure repayment of that loan. Will you give up your car? Will you give up your home as part of that collateral? The credit bureau is going to be one of the places that gather, store, and sell credit information to business subscribers that appear on one's credit report. Credit bureaus that we use in the United States are Experian, Equifax, and TransUnion. Store credit history this is a complete record of borrowing and repayment performance. Also on your credit report, there will have issues of credit reports about consumers' credit history to their business subscribers upon request. Businesses will collect this information about everyone's credit from these subscribers. In a second, I'll show you a sample of a credit report. Credit reports are updated continuously. Information stays on your record for 7 years, 10 years if you had filed for bankruptcy within those 7 years. Information on that credit report will be a summary information, including your public record information of any lawsuits, judgments, divorce, or marriage that have had affected you personally within the last 7 years, your credit information, account detail of your credit, requests for credit history that has hit your credit report, such as needs for loans, and then personal information, address, date of birth, social security number, etc. So a credit report is a record of a consumer's credit history that includes information about credit card use as well as the use of other types of credit. Your credit score then is a number that summarizes an individual's credit record and a history. A numeric grade of a consumer's financial reliability is then determined. A credit score can range between 850 and 300. We consider this your adult GPA. Employers prefer you to have a higher GPA when they're looking for candidates out of college, as well as lenders look for higher credit scores in an opportunity to determine your credit worthiness. So how can I get a better credit score? Well, proper credit use helps develop positive credit history and credit reports. You want to earn a higher credit score. A high credit score gives the opportunity to have lower interest rates on loans and the privilege to use different forms of credit and an easier approval process for future credit. Examples of positive credit use would be paying a credit card balance in full every month, paying credit bills on time, maintaining reasonable amounts of available credit, do not have too many of one type of account, checking the monthly credit card statement for errors, and then checking your credit report annually for errors. Negative credit use could cause your score to go down. So improper credit card use develops negative credit history and then a negative credit report. This lowers your credit score. Consumers with low credit scores have the difficulty in getting loans, difficulty renting apartments, pay higher interest rates, pay higher insurance rates, and have difficulty obtaining a job. Examples of negative credit use would be making late credit card payments, paying only the minimum payment, exceeding the credit card's limit, usually which triggers a penalty fee, charging items that can't be paid off immediately, and owning too many credit cards. What happens if you have no credit? So if an individual has not used credit, they will not have any information in their credit report. So even though you feel like you've got good credit behavior because you've not opened up any lines of credit, you've not developed one of the characters for credit worthiness, which is character. Not having a credit report can cause an individual to be denying credit. So here's the situation. 3 of us are in the market for a new car. After shopping around, we all have found that the perfect one, the window sticker says $15,000, and we don't have the kind of money. We will have to take out a loan. First thing lender does is check our credit scores. So here's the scenario. I'm going to discuss 3 different loan situations. So in the first scenario, you have a FICO score, number 1, of a 750. With that, the bank gives you a 3.69 interest rate. And your monthly payment on that car loan is $297. Loan 2, for person number 2, they have a credit score of 650. They get a 9.25% interest rate. And now that same $15,000 loan requires a $339 monthly payment. And our third person with our third loan has a credit score of 550. They get an interest rate of 12.82. Their car payment now goes to $368. So based on these 3 scenarios of those 3 individuals that have a high credit score to a low credit score, how does that affect their monthly payment on the same $15,000 borrowed? You can definitely see the impact of positive credit behavior compared to poor credit behavior. So when do you need to know your limits? When have you borrowed too much? When you cannot make the minimum payments on your credit cards, your car payments cannot be paid, which means your car will get repossessed, or you can't make your mortgage payments, which that means your house would be foreclosed on. We use the 20-10 rule to knowing your limits. This is when your total borrowing should not exceed 20% of your yearly take-home pay. And your monthly payments should not exceed 10% of your monthly take-home pay. Remember, take-home pay is your extra money after taxes are deducted. So how can one cope with coping with debt? Number 1 is through self-help. Make sure that you've developed and use a budget and you follow up on that budget. If that still does not help, there's debt relief services. These are services that can help reduce, refinance, reorganize, reschedule, or even cancel some debt for a fee. However, use caution when shopping for debt relief services. Next would be a debt consolidation. This replaces several smaller loans with one large loan. Your last choice would be filing for bankruptcy. So what is bankruptcy? This is a legal process that relieves debtors of the responsibility of paying their debts or protects them while they try to repay. The 2 goals of bankruptcy is to provide borrowers with a fresh start and provide a fair treatment to creditors competing for repayment. The types of debt that would be looked at in bankruptcy would be secured debt, and that's a loan backed by a specific asset pledged as collateral. An unsecured debt would be no collateral required, so a court can provide judgment to repay creditors. There's 2 types of bankruptcy. First of all, you can file voluntarily or involuntarily. Once a petition's been filed, a court's going to allow creditors to file claims for repayment. The debts not able to be discharged are going to be things like child support, alimony, income taxes, student loans, and court order damages. Discharge means that no matter what is dismissed during bankruptcy, these particular specific payments will still have to be paid. When you file for bankruptcy, you could select Chapter 7, which wipes out most debt in exchange for giving up most of your assets, except those deemed necessary for survival. Chapter 13 allows you to keep property in exchange for the use of their income to pay the portion of those debts over 3 to 5 years. Your income would then be garnished through your employer. What causes bankruptcy? Many bankruptcy filings are through business failures, charging, opening, and starting businesses on credit cards, or opening up too many loans and the business not being able to be successful. Living paycheck to paycheck, not having enough savings, so when there's a job loss, you're unable to make your payments. Divorce, taking a dual income household down to single income households. Failure to budget and plan. Exceeding medical expenses, especially uninsurable expenses that must be paid to extreme illnesses. And then unexpected disasters. When you have those uninsured experiences and those items have to be paid for, such as tornadoes, fires, and those items cannot be recovered because they were not insured. So what are the advantages of filing for bankruptcy? Well, the advantage is those debts are erased. And some of your assets are going to be exempted from being discharged, and you will be able to retain some of those assets. And certain incomes are going to be unaffected. And the cost for filing for bankruptcy is relatively small. The disadvantages of bankruptcy is that they could be on your credit report for 7 to 10 years. In Chapter 7, not all debts are forgiven. If you owe taxes, you will still have to pay taxes. Child support and alimony must still be paid for divorces and student loans. Many properties must be liquidated, and co-signers, part of the people that would have signed on a loan with you, would have to pay as part of that debt repayment back. So that's our discussion on creditworthiness and the impacts of poor credit. Look forward to part 3 of our Understanding Credit notes.